Hey, it's Andy here. I saw an interesting question today. The question was simply, is life insurance taxable? And I thought about it, and I thought we could discuss in a video. The answer is it's not quite that simple. So let's unpack that and break it down a little bit. So if you have life insurance, and the core purpose of life insurance is that if and when you die while the policy is enforced, your beneficiary will get paid out the death benefit of the policy. Most simple example is you buy some basic term life insurance, where term means that the policy is only in force for whatever, 10 years, 20 years, whatever length of term you buy, assuming you stay current with the payments every year, the premiums. So if let's say you have a $1 million term policy, you pay however much money every month, every year, while that policy is in place. If you were to die, and let's assume it's a 20-year term, if you were to die within the 20-year period, the $1 million death payout to whomever you specify as the beneficiary of that policy will be completely tax-free to whoever inherits it, whether it's a child, a spouse, a friend, a random stranger. The payout of that $1 million completely income tax-free to that person, doesn't even show up on their tax return at all. That's how tax-free it is. Now, what they choose to do with it and what that money does after the fact is a different story. So if they invest it, they take that, they get that $1 million tax-free, put into a brokerage account, for example, and they invest it and it grows to $1.5 million. That extra $0.5 million or $500,000 will eventually be taxable to them. Or if they put it in a bank account earning interest and they get whatever 1% interest, that interest that they get paid on that $1 million will be taxable to them. But the point is the original receipt of that $1 million to them upon your death from this life insurance is not taxable. So that's basic term policy. If you have a permanent policy, some life insurance that lasts throughout your entire life, the death benefit, again, similarly is not taxable. Whether it's $100,000, $500,000, a multi-million-dollar policy, the payout of that death benefit is not taxable to whomever receives it. If you have a policy through work, you work at an employer that has life insurance that they pay for, not you, that's still not taxable to your beneficiaries, whether it's a spouse or a friend or some other random person or relative that gets it. Even though you didn't pay the premiums, your employer did. If and when you die, while you work for them and that policy is still in force, the payout of that death benefit will be tax-free to whomever receives it. Now, typically, those are called group universal life policies. Usually, it's like one-time salary or two-time salary is what your employer will often pay for you to have. Again, that receipt of the death benefit if you die is not taxable to whomever receives it. Often at employers, you can buy supplemental or additional insurance on top of the sort of free amount your employer gives you. You can pay more to get additional coverage. Even though you pay for that policy, it still doesn't change the fact whether your employer pays or you pay, the payout of the death benefit is still tax-free to whomever receives it. There's a little bit of a wrinkle if you were to buy life insurance inside your 401k. So with tax-deferred, pre-tax money. Now, you cannot buy life insurance inside an IRA. The IRS strictly prohibits IRAs from owning life insurance, so flat out not possible. But if you have a 401k, for example, you may be able to buy life insurance within there, depending if your employer allows it. Many don't, so this isn't a common scenario. But if that applies to you, and you do buy some life insurance with pre-tax money inside your employer plan, such as 401k, that's where the analysis gets a little complicated. The death payout, I believe, still isn't taxable. But if you have some cash value, which I'll touch on in a moment, cash value while you're alive, and you take out more than a certain amount of what you put in, there's some tax that comes into play there. Let's leave that outside the scope of this video. That situation rarely applies. Even if it does, it's a more technical, involved analysis, and simply the death benefit is not taxable. There's other cases where, again, that 401k insurance may be taxable. So that's kind of it in a nutshell, whether or not the death benefit is taxable, to which the answer is no. It's not. Now, there's some exceptions, like if your company pays for insurance on you and they're one of the beneficiaries, then some of that payout to them may be taxable. But when the payout is to, an individual, again, spouse, friend, family, random stranger, receipt of the death benefit not payable, not taxable to them, neither federal nor state. So that's the death benefit. Slightly different story. If you have what's called cash value policy, these are permanent life policies, so not term. Again, term is you simply pay premiums for X amount of years, 5-year, 10-year, 20-year, whatever it is. At the end of that period, if you don't die and get paid out on that policy's over. That's it. You have nothing along the way to show for. There's no cash value. There's nothing you can borrow against. There's nothing you can sort of close out and go home, liquidate. It's simply you pay the premiums. If you die, you get the death benefit. If you don't die, that's it. Policy's over. Done. With permanent policies, there is a cash value component. So every premium payment you pay, some goes to pay for the cost of the life insurance, because first and foremost, these are life insurance products. And then some other portion of your principal payments, well, some goes to fees and expenses, but some other portion of your payment goes to this internal cash value. And that cash value will get credited interest based on, there's a few different ways depending on what type of policy you choose. But just know that the cash value, in the early years, it's not great because there's a lot of policy fees and expenses that come out. But if you have this policy 5-10 years plus, then you can start to accumulate some meaningful cash value. If you ever take that cash value out, and cash value is an asset, whereas a term insurance, there is no asset, there's nothing to take out along the way. If you don't die and recognize the payout of the death benefit. With these cash value permanent policies, there is potentially something. Any cash value that you do accumulate is yours. That's an asset. You can take it out if you choose to, or you can take loans against it. Leave the money in there but borrow against it. So if you do choose to take the cash value out, if you ever take out more cash value than what you paid in total premiums, that difference will be fully taxable income to you. And it's not taxed at the reduced long-term capital gains tax rate, it's taxed as ordinary income. So for example, you have a policy where you paid in, let's say $50,000 in premiums over your lifetime, and it has a cash value of $75,000. If you were to take out all of that cash value, all 75 grand, 50,000 of it will be tax-free return of the principal, a return of the premiums you already paid. The additional 25 will be interest that you haven't yet been taxed on, so that will all be taxed as ordinary income to you in the year you take that distribution from your cash value. Now that's if you actually take money out, distribution and withdrawal, if you will. More commonly with these cash value policies, the way you access money is to borrow against it. So you don't actually remove the money, you're just simply taking a personal loan from the insurance company, and they are collateralizing that loan with the value of your cash value. So if for whatever reason you supposed to pay it back and don't, they'll just take it out, the insurance company will take it out of your cash value to pay themselves back. So the money you borrow against your cash value is not taxable income because it's a loan, it's debt, it's not actual income to you. It's no different than borrowing against your house, taking a home equity loan or taking a student loan or borrowing to buy a car or even buying something on a credit card. These are all debt. The money you get forwarded in advance, the money you borrow is not taxable income. Same is true with borrowing against the life insurance cash value. All right, so that's it. So there's a lot going on there, but hopefully it made sense regarding is life insurance taxable? That's why it's such a long answer, because it depends what part of life insurance you're talking about, how it's purchased, with what type of money, etc. So that's all. Hope you enjoyed this. Take care.